We're going to go ahead and get started. I want to welcome you. Good morning, and let you know that my name is Teresa Campbell. You have joined the PIM Printing Industry Midwest and PIA Mid-America Financial Executives Council, and this program is on financial benchmarking. Now, I want to note that all of our attendees are placed in mute mode to ensure quality recording. However, we encourage you to comment and add questions during the program. If you can type those into the Q&A field at the bottom of your screen, we'll ask them at the most appropriate time. Some of your questions may be answered in slides that are still to come. If you have difficulty, try and communicate those in the chat field. Our Financial Executives Council is coordinated by leaders in both the North Central and South Central region of the U.S. They guide our programs and content offered every other month, 6 times a year. The focus is around financial reporting and compliance, data management and security, and financial policies and planning. Our council co-chairs are Matt Wills with L.B. Carlson, Carl Nathy with Myers Printing, Ryan Wagner with Action Mailing and Printing, and Ken Rain with Daily Printing. Let's get started. Today's speaker is Dr. Ralph Williams, Associate Professor at Middle Tennessee State University. Thank you for joining us today, Dr. Ralph.
Thank you, Teresa. I am a little introduction now. Again, Teresa mentioned that I'm Associate Professor of Management here at Middle Tennessee, and I'm sitting here on campus today. So I love it. Engaging with the students is wonderful. We have such great work ethic among our students, and I get called sir 27 times a day. I love doing the research and love engaging in our industry. I say our industry. I led 3 different printing companies before entering academia. I didn't get my doctorate till I was 55. But I love it, and I love working with the industry and connecting and producing research and actionable knowledge back to the industry. Thank you to Printing Industry of the Midwest and Printing Industry of Association of Mid-America for doing this. It really prompted some good thinking. Teresa mentioned the group in this executive council. We had a meeting on Monday, and it was really so helpful. It was good. I was big. This financial benchmarking topic is sweet to me because in the 3 businesses I led, I used that financial benchmarking. We used it to make strategic decisions. Here's a quick story just came to mind. I almost get chills when I tell it. The first time I used it, I brought our management team in the room and I showed them our numbers and on a wall, just wrote them down on a piece of paper taped to the wall, and I showed them the high performers. And I said, what do we need to do? And they looked around, they said, we need to do this, this, and this. And then they got up and went and did it. And it was some major stuff, moving some people around, parting ways with some people, changing some things. But it really did prompt good strategic thinking. And I think Ken has had the same kind of experience. Ken, you mentioned that. Would you want to share something there?
I will. And Ralph, I do use these benchmarks. I still draw on the old PIA ratio studies. That is part of my accounting for the annual meetings that we have, and trying to compare how we do against quote unquote the leaders as well as the average. And now some of the stuff is dated, and that's why it's so important what you're going to show us today, that we need to participate in this as a group so that we can gather this information and use it in our businesses. I was privy to your stuff, your findings on Monday, and just looking at them. And as we get through them, you can if they're thought-provoking, and you want to be able to say, yes, the leaders are doing this. How are they doing it? And then looking at your data and say, we need to be better in, like you said, this area, this area, this area, and go and do it. So I'm going to let you dive in. And just at the end, I highly recommend all those people on here, if you have a chance to participate, if you're not in the financial side, pass it off to someone in your group that is, so that we can get really good numbers. We need more. I think we were in the 60 company participation. We need to get over 100. So I'll leave it back to you, Dr. Ralph, and I'll enjoy listening. Thank you.
Well, and you'll chime in, I'm sure.
I will.
And Ralph is fine. So now in this title, inferences drawn from the 2024 financial benchmarking survey, Ken made a good point that our participation was down a little bit this year. So we're saying we're getting inferences from these numbers as far and looking at last year's numbers too, and trying to build from that. Okay, here's where we're going forward. We'll first start looking at income statements and comparing high performers and all companies in the from our survey. Then we'll look at value add, which is a very helpful tool. We then look at financial ratios such as current ratio and those sort of things, and then cash management ratios such as days in accounts receivable and that sort of thing. Then we ask some other questions in the survey, and we'll talk about an outlook, not outlook, but our survey focuses on the financial data from 2023. But we also ask, well, how's the 2024 looking, the first quarter, and we'll give you some feedback there. We ask, how do you analyze financials? And we had, I think it was about 6 different quotes that I shared. More than that we had, but 6 that struck us, and we'll put that there. We also looked at the employees per $1 million in revenue, number of employees. There's a new GAAP law related to lease, and Matt will talk some about that. Then we make some accounting suggestions from there. We finish with a section on survey suggestions and talking about that, where we'll seek your input. Okay, first the income statement. Here's the income statement, and don't be overwhelmed by all the numbers. We're going to look at the individual sections here in just a little bit, but you'll see that we had all firms. There were 63 firms in our survey that were useful data, and then we found high performers. 15 of those we identified, and there's the numbers there. Last year we had 104. We actually need about double that 104 number, because we would like to produce these numbers for different industry segments. For instance, when I was running printing businesses, all the $5 million printing companies were very similar. Now they're very diversified. Some are labels, some are sheet fed and digital, some focus on digital. They're all over the place. We'd like to have statements like this for different strategic groups. So we're working to improve participation. We'll discuss that some more at the end. Now, so in all of these charts that are coming, we've got total revenue, and then the percentage of total revenue for all firms, and then higher performers. And then we subtracted this, so we show the difference. And in this position, the high performers were 0.03% below the all firms, just as an example. So let's move forward and look at the first section. The first section is materials and outside services. So again, revenues 100%, and you can see paper and substrates 21%, 21.5% for both high performers and all firms. Other chargeable materials, again, very close. Outside chargeable services, again, close. And we included freight and postage in this section this year, a little bit different from last year. And then here's the difference between total materials and outside services between the higher performers and all firms, just a 0.15 percentage point difference. they're very close, and that was surprising. And it was, but it was similar to last year. We had the same numbers, similar numbers, very close on total materials and outside services. Anybody want to chime in or have thoughts about this? Okay, we'll move next to factory cost. And so when we look again, revenue 100%, and then we look at payroll with taxes and benefits, all firms at 21, almost 22%. Higher performers at 19.36%. You see a 2.5% drop. High performers are doing it at 2.5% less than other companies. Now, other factory costs, there's a bigger difference. It's over 4 percentage points difference. And then I'm going to skip down to total factory cost. You know, almost a 6% difference. So, and I'll come back to depreciation in a second. So, again, this is consistent with last year. Higher performers are running their shops more efficiently. Any thoughts there?
Yeah, I think, Ralph, from our client base and what we look like, that what your survey shows is kind of what our clients experience. The ones that, on average, that can control their labor and maybe efficiently use overtime or temp labor or cross-train employees to have a lower amount of wages paid for payroll anyway, generally tend to do better. Same with the other factory costs, the ones that are controlling maybe spoilage a little bit more, or controlling repairs and maintenance, doing more preventative maintenance, so there's not large repairs, things of that nature. If they can get out ahead of the problem and reduce those costs, they tend to do better with kind of their gross profit.
Yep, and I gather from this too, with you see the depreciation's a little bit higher. That's telling me it's probably newer equipment. So a lot of these firms that are the leaders tend to be able to get newer equipment in. And to Matt's point, they have less repair and maintenance. And so that adds up fast. I know that we try to have a set maintenance schedule for our press room. And each shift has to do, specific maintenance per week, per month. And we find that that's really helping us out in driving our costs down.
Anytime this executive council talks, I write stuff down. Y'all are good. Y'all are good. Someone asked about how did the high performers differ from do you see that chat point there, Teresa? I'll address that in just a second. So I see that's a very good question. It's a question that Matt asked Monday that prompted me to look. So, and to go along with Ken's point that maybe they're using higher level equipment, new equipment, look at the depreciation. Depreciation's higher for the higher performers. That may lead to more equipment purchases, or they're using automation. I just saw something from Jimmy, maybe using automation. Yeah, that's a good point. Anybody have thoughts about the difference in depreciation? The bottom line, and this is consistent from 2 surveys that we've done, the higher performers are operating more efficiently in their factories. And it's, again, you can use these as benchmarks as to, comparing them to where your company is. Moving on. Okay. Now this is the next big section is the administrative cost. So total revenue, again, 100%, payroll for administrative cost. I higher performers almost 1.5% below, and then other administrative costs a percentage point below. So about 2.5 percentage points below. It was interesting, and this is consistent with last year's. And again, these are benchmarks that you can use. These are consistent with last year's numbers. And I did a luncheon in Louisville last year, and I shared this, and there was a printing company leader in the room, and he looked at me and said, you know, we don't look inside our office for efficiency like we do in our factory. And I thought that was really striking. You know, anybody want to chime in anything on this?
Yeah, I think, Ralph, you know, using the efficiency on inside the office, you know, with the rise of ChatGPT, with the rise of automation and technology talking to each other, you know, I would venture to guess the high performers are more streamlining that process from estimation to and through the billing cycle to where they maybe don't need to have so many touches with it. The systems talk to each other to where maybe they have reduced headcount as a result, or they have the headcount working in different areas to produce more value. So it'd be interesting to know how, you know, what type of automation is really driving that value or that difference.
I did hear from one printing company or association leader who shared that he had a printing company that was doing exactly what you're saying, Matt. They were using AI to streamline processes. Any other thoughts? Another thought is outsourcing. You know, maybe outsourcing things. My son was he was the manager and director of sales and marketing for a printing company, and they outsourced some of their looking for potential clients, and it was really an efficient approach, and saved them some money. Here's another question. I did a lot of family business research when I first came into academia, but how might having family members working in the office affect this? That's just something to consider, you know. And you make those choices and just know where you are. Know where you are. Now here's an interesting thing from last year's survey. We wondered if leader compensation could affect this. But we found, and it was a very subjective question, but we found that the higher performers who were spending less on administrative were paying their leaders more. And that was interesting. Moving on. Okay. All right, now this is the next is marketing and sales and marketing cost. You can see the difference of where the higher performers are spending about 0.5 percentage point more on their sales and marketing payroll, and then just a touch more, but in total about 0.5 percentage more in sales and marketing cost. And again, this is similar to what we saw last year, and these are some benchmarks you can use. Thoughts from the Executive Council?
I think part of it is, oh, go ahead. Go ahead, Ryan.
If it was possible that some of the higher performers are paying a higher percentage on their sales.
Higher compensation.
Right. Because they're able to.
Yeah, I was thinking that, you know, they're driving to get new business or more business, and they're finding sales reps that realize that they're getting paid more than the average and going out and selling more. And then also with the marketing costs too, you gotta spend a little money to make a little money, and getting your message out. And we find that if you can get the right message out to your customer base, they're more responsive. And now with all the tracking that you can do with QR codes And we find that if we can send out a mailer and track as these people are logging on and seeing, you can kind of have real-time data to see if your marketing efforts are working.
Kind of related to all that, Matt made a good point Monday. We might explore this in a future survey. Are the higher performers compensating more on value add or on the sales dollar amount? So that's a we were big on compensating for value add, and it was a big deal, and it focused our salespeople to focus on the right work that would generate value add. Another aspect of this is, are you seeking new prospects, or are you just trying to grow from a organic standpoint, which is big. A leader said, are we hunting or are we farming? Are we hunting for new business and investing in that? Or are we merely wanting to farm and grow the accounts we have? And I thought that was relevant. And you've got to invest some to do that. Moving on, Teresa, you're the one that nods. Okay. So this is the bottom line. And you see the big difference in income before taxes and EBITDA, the huge difference. Are y'all familiar with the book Atomic Habits? It is great. It talks about how you change the habits in your life, and little changes add up. They add up. And I see that in these surveys, or in these data. You make a bunch of little changes, and they add up. They add up. So I think that's big. Now, EBITDA, earnings before interest, taxes, depreciation, and amortization. I'm a big fan of that. Indeed, my son gave me a T-shirt that's got EBITDA on the front of it. And when I start talking about this in entrepreneurial financial management, which is talking about the same things we're talking about today, at one point I unbuttoned my shirt and showed them EBITDA on my T-shirt in the class. So, but very professional professor anyway. EBITDA is a great comparison tool of companies between regions, because tax rates are different in different regions. Depreciation is different depending on where they are in their stage of life in the company, and also interest is different based on how much they finance their assets with debt. And that's a choice. And I can make an argument for a lot of financing with debt or not financing with debt. So, that's important. But so those are decisions. If you look at EBITDA, it's a good comparison tool. Matt, would you agree with that?
I think so. It helps especially make companies comparable across the nation, across how they're maybe structured from a capital perspective, all of that. So it kind of levels and normalizes out the playing field, so that you can compare yourself to other companies or high performers.
Yes. So, but you see the difference. My goodness. I mean, there are companies that are up around 18 to 20% EBITDA, and there are high-performing companies in our industry. And Matt, are you seeing this among your clients?
Yeah, we're seeing clients that are, still doing pretty well. Some that aren't. It is more, to your point earlier, industry subsect specific. But overall, there are still companies that are still having good years and still be able to perform pretty well.
Okay, moving on. Teresa? All right. Teresa, you're going to hurt your neck by the end of the day. Okay, let's talk about value add. Value add, the value a company adds to what it buys for its customers. And the example I thought of this morning was the restaurant industry. They buy food, they buy inventory, and then they'll add value through what they do with that food and the service and the atmosphere and that sort of thing. So in the same way, a printing company buys paper, outside services, or chargeable materials, and they add value to that for what they do with those services, chargeable materials and paper, and how they pull those together as a service, if you will. So value add is essentially value add equals revenue minus the materials and outside services. I was a big fan of looking at cost as a value add percentage because it makes the differences when you look at as a percentage of value add as opposed to this percentage of revenue. It makes the differences really jump out. And Ken, I bet you've experienced that too.
Yeah, Ralph, we pay our sales reps on value added. So our goal is to drive our business to what we do. And we try to buy the paper and our outside services at the best rates available. And we're finding now that we have the ability in real time to compare pricing, with these vendors and make our decision based on that. Sometimes you have to step outside based on availability, but that has sure changed in the last year and a half as things become more available.
Am I sizing up value add correctly? Matt, Ken, Ryan, Teresa?
That's how we judge it.
Okay. Matt, are you nodding? Ryan?
Yeah, that's how we judge it, Ralph. And when we help clients with their benchmarking and looking at past results, we primarily and almost exclusively look at the value add concept and benchmarking those expenses to value added sales. So it can help drive and show the bigger, variance is a lot easier.
You're saying it just like I did. Matt, I'm worried about you. We're thinking alike. So don't tell your wife, okay? So here's the value add numbers. Again, value add is a percentage of revenue, really kind of close. But then when you get down into these numbers, all firms, high performers, factory cost, big difference, and payroll, other factory costs, look at that, 6.5% difference. Depreciation, again, higher, a 10% difference of value add between high performers and all firms for total factory cost. High performers are spending less, 3.7 percentage points less on administrative cost, but they spend about a percentage point more on sales and marketing cost. Interest lower, and I didn't make this point earlier. My thought about interest lower in all these categories is that's the product of long-term health, long-term business health, keeping that interest down. So then look at the differences, 12 percentage points in income before taxes, and then 13 percentage points a difference in EBITDA. Any points there you want to add or thoughts?
Dr. Ralph, I'll just bring it back to the question that was asked based on company size. You see payroll, including taxes and benefits, and is there a size factor there that's impacting these numbers?
Thank you for asking. I had a note to that because Matt prompted this question, and I went back after our discussion Monday and looked at the data. I looked at size. I also looked at industry segment, which was we asked in our survey what percentage of your revenue as a guess is on commercial printing, digital, wide format, labels, outside, other complementary services, that sort of thing. What differences, what processes do you use? Sheet fed, digital, wide format, those kind of things. And I could not find these high performers were all over the place, Matt, as far as size and industry segment. It was surprising. And
there probably is still some scalability there, economies of scale. I mean, it is a concept. I wonder, I kept thinking about this more, Ralph, and I wonder if the higher performers maybe have a better handle on scheduling. Maybe they have a better handle on their workflow. So they can efficiently get the product printed and get it out. And they're not maybe having to use overtime. They can control that a little bit more. That would probably lead to what is driving that payroll being down. Obviously, there is some component of scalability. There has to be though some component of being able to have a better workflow, less times touching the product equals less times people needing to pay people, controlling when having the foresight to get things printed maybe a little faster to meet timelines, so they're not having to have their whole staff work overtime, and maybe they can eliminate a shift. Things like that, I think, are also a factor, though.
Well, there are a lot of factors, and I'll tell you stories of two different small businesses that would fall in this. One is they're probably around 1.5 million, or maybe 2 million in sales. They are in a kind of a rural, smaller area, and they are selling printing and complementary marketing services to small businesses, helping with their web, this and that, and the other things. And they are they're marketing that well, and they're doing it well, and it's makes their numbers look good. In the third business I ran, and really in 2 of the 3 businesses I ran, we were big on that scalability, Matt, but we did it again. When we were a smaller business, we would budget at our lowest, what we thought was a low expectation for revenue. We would staff accordingly, and then we would say to our employees, our goal is for you to work overtime. And we worked 4-day weeks, and we said our goal is for you to work the 5th day too. And if that's not comfortable with you, then you probably need to look somewhere else. But we were expandable and contractible. And so our other factory costs stayed the same. Our payroll went up, but we were covering that as fixed cost, if you will. And it really it put us in these high performers. So yes, I agree scalability, but there's ways small companies can get in this group too.
I'd be curious
again, yes, Ryan.
Sorry. I'd be curious what the length of time, the average employee length of time that they've been with the organization, how that impacts whether they're high performer or not, because you keep the same person for 20 years, their ability to produce versus having to hire new people and retrain every time.
That is a great question, and it's related to some research we did last October, and we found that companies that had a strong employee value proposition where they said, this is what we provide our employees. And it wasn't superficial, it was something that was meaningful, and they marketed that. They had less turnover, and my perception was those tended to fall in the higher performer group. So great question, Ryan. Yes. And my perception today, we all have staffing needs. There's fewer people out there. There's a supply and demand. There's not as much supply, so you've got to market yourself and be a good place to work. You got to be a good place to work. Anything else before we move on? I tell you, Teresa, any big chat things that we need to address? I think we've addressed 2 of them.
Yep, not so far.
Okay.
We definitely encourage you to type those in so that we can include your comments in the conversation.
Okay, we're going to move on to financial ratios now. And our numbers were really small, and it affected us a little bit in this, affected us a lot. But you can look at current ratio. It's fewer than last year. You see, we had all firms. We had 25 firms where we could find data to produce this. We only had 3 high performers. Last year was 56 and 11. When you look at the current ratio, which is current assets divided by the current liabilities, and when I produce my reports, I'll have the formulas for all of these in the report. You see, last year, the current ratio was 3.3 for all firms and 3.6 for high performers. This year, 2.81 5.71. This number, these numbers were really high, I thought. So this number really is big. I'm kind of seeing, I've always felt like 2.0 was a good current ratio. But we're seeing higher numbers right now, 2 years in a row. Any thoughts related to current ratio? It's something that's important to measure and watch the trends in your current ratio. If your current ratio starts going down, you want to find out what's going on before you have cash problems. And I'm kind of big in my class about saying build a trend quarter to quarter, month to month of your current ratio. All right, now quick ratio is the number, it's the current ratio minus the inventories divided by current liabilities. And what that is that's more liquid current assets when you take out the inventories. You'll see that we didn't produce any results because the numbers were so scattered. Some companies show work in process, some do not. Some show inventory, some do not. And we'll talk about that a little bit later when we talk about accounting suggestions. But there was such a variability in these 25 firms, I decided not to do the quick ratio calculations. Revenue to total assets. Now, as I'm talking, please, Ken, Ryan, Matt, if you have any thoughts, chime in and I'll stop. But revenue to total assets is total revenue divided by your total assets. How many dollars of revenue do you generate for every dollar of assets? It's a very useful tool. If these numbers this year, 1.66 for 25 firms, $1.76 for every in revenue for every dollar in assets for every high performers. Last year, both around 1.9. Here's where this is a tool. If I'm not producing the EBITDA or the income that I want to, should I attack more on cost or more on sales? If I'm producing less than $1.9 per dollar in assets, if I'm producing less than $1.9 in revenue for every dollar in assets, I better point to sales a little bit more. You probably need to do both, but point to sales a little bit more. So that's a good indicator for me. Total debt to assets. This is the amount of debt. All firms at 52, 41.5 for higher performers. All firms last year at 46, higher performers at 42. You know, these numbers are pretty consistent. It's really a choice of how much you need or you want to spend in debt. The return on total assets. Last year, you know, what is your return? It's income divided by total assets. Last year, all firms 13.4%, higher performers 34%, almost 34.5%. This year, 2.8 and 20. This is a great tool, and I wish we'd have used this more. I wish sometimes I made big equipment decisions. We made big decisions, more me, on an emotional thing. We bought a web press one time. Oh, I want to buy a web press and a perfect binder. And it worked out well for us. But I think there's some benefit. I know there's some benefit. If you're wanting to buy another big piece of equipment, you look at you build a budget and you say, what will this generate as far as income? What will I have in return on assets? Is making that investment worth it? And what do I need to do in generating revenue and maintaining cost to generate that? So I think it's a great tool. I wish I'd have used it more. Return on equity is a good tool to use to see what return your business is getting, what you're getting for your investment in that business. And I think it's a good tool. Any Any comments from the executive team? Executive council, I'm sorry. Okay, we're moving on to cash management ratios. And again, we got all firms, higher performers, all firms, higher performers this year and last year. Days in inventory, they were scattered. I didn't include it. Last year, days in inventory, 102 for all firms, 85 days for higher performers. And that was in 22. We think that was related to the paper issues. We hope it's down. A superficial look at this shows that it's down a bit, but the numbers, they weren't accurate enough to put out there.
And Ralph, we are seeing that in our client base. On average, I think all of our clients' inventory amounts went down. And in talking with them all, it seemed in 2022 there was some hoarding of paper or whatever the case be, whatever you want to call it anyway, due to the allocation issues. But that kind of, for the most part, have seemed to be flushed through in 2023. And on average, people are holding less inventory and carrying less inventory, and they're more back to a just-in-time feel like they were pre-allocation issues.
Yes, I agree with you, Matt. Again, you need to worry about that. But by superficial look, I'm seeing the same thing. And I'll say this, and this is from doing research in industry about supply chain and with my supply chain colleagues, professor colleagues. I think there's potentially another paper challenge coming. Potentially, we'll see. We'll see. So be prepared for it. Days in accounts receivable last year, 47 for all firms, 39 for high performers, 44 and 47 this year. That was surprising. But again, only three firms there, so the numbers are a little scattered. My goal, I think this is an important thing to measure. My goal was 42 days. I wanted to be 42 days or less. And we developed a strategy for addressing that. We looked at it every Wednesday, our accounts receivable. We had somebody responsible for monitoring that. And she made the calls to follow up on invoices and that sort of thing. Then we looked at cash budget every Friday. Any comments there? My goal was 42 days. Your thoughts about that number?
We're working towards that mid 40s for days in accounts receivable, and we do monitor it. We also look at the over 60, over 90. And we're really striving hard to keep that under 2%, 3%. And we have some customers that are telling us when they're going to pay us at 75 days or 90 days. And those are the people, the outliers that you just have to deal with. But for our core set of business, we're really trying to work towards that, low 40s for days in accounts receivable.
This is all printing companies, almost all printing companies are small businesses, and there's so much that a leader has to monitor and take care of and that sort of thing. But if you'll measure and look at these numbers, it will cause you to work toward the right end there. It'll cause you to do it. Days in accounts payable, it appears there was a higher number in 2022, and those numbers have dropped. And I've wondered if that was related to the drop in inventory we're superficially seeing. I think Ryan's nodding. Maybe so, maybe so. And this is important to monitor, what are you doing? To measure the cash conversion cycle, you take the days in inventory, days in accounts receivable, minus the days in accounts payable, and it shows you how long it's taken you to convert what you buy in inventory to cash. Because we don't have days in inventory, we can't measure that, but it shows you how these things are related. Your cash is healthier with fewer days in inventory, fewer days in accounts receivable, but more days in accounts payable. So moving on. Okay, we're pretty much done with the numbers. We asked this question because our numbers look at 2023. We wanted to get a view on how things are going for the first quarter of 2024. We said, how does your company's first quarter revenue compare to its 2023 first quarter revenue? And they had a 1 to 5 scale, much lower, about the same or higher. We had 75 responses. The average response was in the middle. And you can see this is the number of responses. It's kind of a bell shape, kind of a normal distribution there. Then we asked a similar question related to profit. How's your profitability comparing? Again, a 1 to 5 scale, again, 75 responses, 2.8 the average, and another bell curve, if you will. The big taker, again, normal distribution of bell curve. My takeaway is in our industry, there are firms that are doing very well, and there are firms that are not doing so good. And to me, from a positive standpoint, that shows potential. You can do well in this industry. There are companies that are doing well. Any thoughts? Matt, y'all?
When I see this, it makes me try to see where we're at in that distribution, but it also, gets us to strive towards better. And that's going back to looking at those numbers and analyzing them and see how you weigh out. But constant change, you have to keep looking at ways to better your business. And, these numbers help you and guide you to kind of just put focus on a certain area for a certain period of time and make that area better. And then you can fill in, on the other ones or go after those other areas in your business that are lagging or underperforming, and just constant change. You have to keep up on it.
There was a point Ken made that really resonated with me, that looking at these benchmarks will prompt you, will motivate you to try to do better. And if you share these with the team, and again, I shared these with our teams, and it prompted us. It was funny. I had our team came to us and we need to buy another folding machine. And I said, to buy another folding machine, we need to generate this much revenue. Can we do that? And they said, probably not. And they walked out. Good points, Ken. All right, we ask a subjective question. I'm sorry, it's a little long. Share processes you use in applying, analyzing financials, what you look at, when, how often you analyze those, who's involved, and that sort of thing. And Matt went through these, and he will discuss these, and then Ryan and Ken will chime in. So here's the first one. Matt, you can just read it too.
Yeah, so people responded and said they compare percentages year to date, prior year, monthly percentages to a column of income and expense and compare it to the annual budget. We think that's great. We advocate that to our clients all the time. You should be having you should be setting an annual budget, benchmarking how you are going, how the budget is working through the year as you're going through the year. And then also, what are you doing? How did you do last year? Was April a down month last year and April was a down month this year? Is it just always going to be, or did something change that you were unexpecting? And do you maybe need to shift focus now and maybe change your strategy so that it doesn't affect future months and you can still have a good year, things like that.
To the annual budget, I know Ken and Ryan are chiming in. We've seen in research the proportion of small businesses that budget is very small. Not many budget. You're nodding, Matt. And we actually have some research. We're going to be looking at some data from the printing industry, how many printing companies budget, and look at their financial ratios and how is that connected to. So that's coming from us. Okay.
What I like to do, Dr. Ralph, is I like to take our monthly financials, and we have a budget, and I do budget versus actual. And I've got a spreadsheet built that I can analyze month by month and then quarter by quarter. And then I also look at it just from doing it for so long. you know where your paper needs to be, where your outside purchases, ink purchases. And when we have variances, that's what I bring to our executive group, is we talk about the variances and then the why. And is that something that's going to be a trend? Or is it just a one-off? And I try to identify the one-offs, saying if we had just a month where we needed to do this, that, you know, then we analyze it and say that skewed our numbers. It should be better over a period of time, like accounting fees. We get those right at the beginning of our fiscal year for the previous fiscal year. And so I budget for them over the whole period, but we see a higher concentration in the beginning. And so I try to accrue, put them in as prepaid expenses to kind of smooth it so that we can look at the financials and try to keep them on an even basis.
Next quote.
So they, again, they look at monthly. I think a lot of the respondents said they look at monthly, which we would, again, advocate you do. They mainly focus on gross profit, net profit, and sales from the same period from the previous year. To kind of going off Ken's point, gross profit and net profit, you know, if you, that really will help you determine if things maybe happen that you weren't expecting. If, you know, historically your gross profit is 30% and all of a sudden in 1 month it's down to 25%, is there maybe an unexpected price increase from your vendors that you receive that, okay, we might need to pass along or whatever? But if you aren't looking at that, you can't make decisions and you can't react fast enough. Then I would imagine a lot of the high performers are doing that. Again, just comparing percentages and costs to the previous months and years. Again, a common trend. They look at full month. So one respondent says they look at full monthly financial statements, a trend in sales volume, growth margins, net income, and then the statements are shared with the executive team. And I think that's a great point. I know, Ralph, you mentioned that as well. Sharing the information with your executive team is critical so that they understand what's going on, so they can bring that to their departments that they're overseeing to help push out decisions to keep moving things forward. And then the same kind of similar respondents, they have a 1-page monthly benchmarking report that utilizes survey results from the survey. And I think the key point there that we're kind of implying throughout all of this is this respondent has developed KPIs or key performance indicators that they are looking at on a monthly basis to see what is going well and what isn't going well. And then they're reviewing that. And again, making decisions based upon those numbers that they're coming in. So I would imagine a lot of the high performers are doing that as well, that they have developed a KPI system. They are looking at this on a monthly basis and they are managing it so they can keep their margins and they can keep their performance sustained at a higher level. And then just, again, they look at things the 10th day of the following month and the major ratios. So again, the common trend of looking at things monthly and looking at ratios. And then to your point, Ralph, looking through all of those, maybe the liquidity need ratios, one respondent looks at them so they can determine the cash flow needs of the company. So they can hopefully not have to dip into line of credits if they need to, or they can plan for that more, etc.
I moved through those pretty quickly. Anybody have anything else to add? They're harmonious. They're saying a lot of the same thing, but they kind of reinstate it. Any other thoughts?
My thought is you just have to make it a habit. You know, the stuff that Matt just laid out is stuff that everyone should do if you're not doing it already. And once you get into the habit of doing it and reporting it that way, it's very beneficial. And we're employee owned. So we're a little different beast. So sharing with management, for us, that's natural. Whereas, you know, a privately owned business, they may not want to share some of the financial notes with their rank and file, whereas all of our employees are owners. So we share that, you know, we do quarterly meetings with our employees as well as an annual meeting, and we go through the financials on that annual meeting. And I lay them out for the employees on a PowerPoint. So it is beneficial because then they can say, oh, geez, or oh, great, we did well. So it's important.
That prompted that back to that book that's really speaking to me now, The Atomic Habits. You put these habits in place and it makes a difference. Another thing I saw in research when I was over the Christmas break and looking at another research topic, and it said that, now see if this resonates with you, Matt. It said that small business leaders typically don't really work with their accountants. They just get numbers from their accountants.
Yeah, and I think that resonates, Ralph, and I think the reason why it resonates is maybe some are small business owners who don't have maybe the capabilities in-house, don't really want to work with accountants externally, but working with people who know how to do benchmarking and looking at these ratios can ultimately lead to a broader discussion of where we can make your business, where you can make your business better, where you can start reaching that higher performance level status. And if you don't have that internally, we would definitely recommend working with somebody who understands all of that, because it's worth your weight in gold for sure. As you're seeing the high performers, you know, having better metrics overall, and I'm assuming that's what they're doing. They're either working internally with people who have that expertise, or seeking it elsewhere outside of their organization.
The note I just produced was use an accountant as a consultant more than a numbers producer.
Correct.
Yeah, Ryan, you really squirmed up when I made that statement.
Yeah, I think probably we're more of a family business, so we've always felt we have to have our eye on the financials all the time. And just a little surprising that you wouldn't have at least somewhat of a finger on the pulse of where you're at.
Okay, moving to the next topic is employees per $1 million in revenue. And there were, let's see, I forget, there's 7 groups here. I had about 10 to 7 in each category here. The big message is that the scale, like Matt mentioned before, there's as you get bigger, you produce more with fewer employees. A thing that's stuck, and we've seen this in multiple studies, but the thing that really spoke to me here was just because you're growing, don't think you need to add people. Try to do more with less or more with the same. Any thoughts?
Yeah, I think kind of going back to our earlier comment about the scalability, obviously it is a trend, but it isn't the only reason. If you look, there's a broad, 2 million to 30 million has roughly about a 1 employee difference in $1 million per $1 million in revenue. So that is obviously a lot of employees, but savings, but not substantially more from 8.3 to 5 or 8.3 to 3. So just something to consider, that scalability is a factor, but it isn't the only factor.
Right. Depends a lot on what you're doing too. Yeah, that company that's very successful in doing marketing work for small businesses in their region, they have a lot of employees per million in sales, but they're doing it very well. All right, now I'm gonna hit this next slide, and Matt's gonna get he'll get the chills when I hit it. So he's gonna describe this for us.
Yeah, and I'm hopefully not gonna treat this into a learning. Hopefully you have all heard about this, but in 2021, GAAP released a new standard that was effective in 2021 that required all operating leases to be capitalized on the balance sheet that were greater than 12 months at their present value, similar to what financing leases or the predecessor to that, capital leases were. So this really just aimed towards operating leases. There were exceptions, like I said, under leases under 12 months did not need to be capitalized on the balance sheet, or month-to-month leases didn't either. So really when we're looking at benchmarking, towards these studies or to prior, company historical results, we have to consider that as well. There might be some companies that have a liability for future value of operating lease payments on their balance sheet, and there might not be for another company, all dependent upon how those companies have their leases set up. They said they could be two identical payments, but one is a month to month and one isn't, has drastically different liabilities, and that'll affect potentially your return on equity or debt to equity. Debt to equity, sorry, and those ratios that involve the liabilities. We kind of have advocated to our clients to exclude these from any of those calculations, or to somehow normalize it out, because these are really not tangible liabilities. These are liabilities for the future which you haven't used yet. They're not your accounts payables. They're not your debt that you've taken out on a piece of equipment. These are future values of payments that may be considered intangible at this point in time. And I know, Ralph, you had said 21 companies reported of the 73 or the 63, or I forget the number. So roughly probably a third of the companies have these lease liabilities. Maybe the other 2/3 don't, maybe because of month to month, or maybe you didn't know about them. So again, whenever there's a gap change, we just want to make sure when we're benchmarking to consider what that change does to some of the ratios, because they can throw you out of whack, and you can look at it and go, man, that we're not doing too well on the debt to equity or whatever, but that might be because of this lease liability, for example.
Matt, does building rent apply at this?
Yep. So depending upon how your leases are structured, again, if it's an operating lease where, the printing company has a 5-year lease with the building operator or the building owner, that building rent would be capitalized on the balance sheet at the present value at the time you entered into the lease. So you're going to show a pretty substantial liability. And for a lot of our clients in 2021, that's what happened. A lot of our clients, woke up on their financial statements at 12/31/2021 with a couple $1 million liability that really isn't per se real. It is real in the fact that they owe the money. They haven't economically gained that value yet, though. So it's a really intangible liability with a corresponding intangible asset on the books. So it really just grossed up your balance sheet. But it unfortunately made the balance sheets on the liability side look really bad.
Interesting description, Matt. Thanks for sharing that. And that it's not tangibly there yet. That's an interesting approach. Well said. Well said. Moving on, any comments? Okay. So we're getting close. This is I had said to in the survey, if you like, you could send me your financial statements and I will enter that into the data. So I had about 25 companies send me their financial statements, and when I tell and please that when I'm done, I'll destroy them. I'll get rid of them. Nobody will see them. You know that. When I tell my accounting colleagues that, they're floored. That companies share these numbers, but I'm blessed. It's a blessing for y'all to do this. But in looking at it, I came up with some suggestions and bounced these by Matt Monday, and he nodded. But you want to try to, in your accounting, to separate into different categories, and these are the categories that I see that are relevant, but also include the payroll for each, payroll and benefits related taxes for each category. I saw in many multiple financial statements, the factory pay or the payroll was one element altogether, as opposed to putting it in those different categories. if you maintain inventory, or another item that's a big amount on your shelves, you want to measure it and record it as a current asset. I saw, not in this survey, but I saw multiple companies I'm familiar with who grew their inventory, but really didn't measure it and monitor it. So it's something to keep in mind. And it's changed because of what's going on with paper. You want to use categories. You want to put detail, not too much, but some. There's a good point from Kevin. I'll get to that in a second. But and what prompted this is I saw one financial statement where they included every maintenance and repair invoice, and it was mixed up in the sales and marketing and in admin categories. So it's just, as opposed to putting them together and put them in the right place. If you use bonuses or profit sharing, divide it in the different categories. So those are just some overall thoughts. Now, what was that question, Teresa, that somebody just popped up?
Are the sales team employees included in the employee per million in revenue data numbers?
That is a great point. Who was that, Kevin?
Kevin.
Kevin, I need to say total employees. That is the total employees. Okay. Thank you, Kevin. It's a great question. Total employees. And I'll change that on this slides before I send them to you. Matt, any points about this accounting suggestions?
I just echo your categories. I think the industry, all the clients that we have, we try to advocate that they put the accounting into these separate categories. It'll help definitely with the benchmarking to not only year over year, month over month to your budget, but maybe to help make things comparable to other companies when you're using your study or different ratios that you might come across. And it'll also help drive into where exactly the payroll you potentially are over or under, or where exactly are you in comparison. If it's all lumped into one, it's great you've identified maybe potentially an area that you need to address, but now you don't know where to address it. It just is, it's somewhere. And that often leads to no decision or the wrong decision, versus if something that's broken out into this kind of level of detail, you can at least identify the specific area you need to address.
Right. Well said. Well said. All right. It's the last serious question. What we want you to do is address these, if you would, address these questions in the chat box. Do you see value in the information from our marketing surveys? How can we improve our surveys, reports, any suggestions, and what can we do to increase participation? And then, Ben, I hope that you can record these or somehow and send them to me later. Well, we'll look at some of them and see what we see, but I hope you can do that. Ben, is that possible?
Yes, it is.
Yes. Okay, good. So while you consider putting some of those things in the chat, Teresa will share some things that's coming up with the PIA of Mid-America.
Really, and Midwest as well.
Midwest, I'm sorry.
Really, from Minnesota all the way down to Texas, the central part of the country. There are two important things that I want to mention to the group, and that is that the Wage and Benefits Survey is going to launch mid-June. We hope that you will all participate in that survey. It's important to help us measure labor costs and help you to manage labor costs that impact your culture and your tenure, definitely your retention and your recruitment. A new exciting element this year with Wage and Benefit, particularly for those of you that have done it before, we have incorporated a feature where you'll be allowed to upload an Excel file that's been saved as a CSV for your wages. And that should be fairly seamless and help to speed things up for you considerably. The second item is the next Financial Executives Council meeting, which is scheduled for July 17th. The topic is going to be sales tax nexus, which we've discussed before in this group. but there's going to be an updated presentation so that it brings it to the current state. So I hope you'll mark your calendar for 11:30 on July 17th. All right, Dr. Ralph, we have some comments coming in.
Will you share them with me, Teresa?
Certainly. If you had a formatted spreadsheet for the data, it would help make the results more uniform. If you have something that you can share and they could follow along with that, it might help the uniformity. And then Jean says she does see value. Helpful for us to benchmark on their own results. Improved if you're able to stratify by size, require enough participants, she realizes, but size of company, of course, impacts the numbers, and perhaps personal outreach would drive more participation. She didn't recall seeing the request to submit the data, but she signed up for this webinar, and at the time was asked to submit the data. She would have been happy to do so.
I think it was Ken who said providing an Excel spreadsheet.
Yes.
Yeah,
yes.
interesting thought, Ken. All right, moving on.
Yes.
Okay, I will send Chris and Teresa a PDF of our slides so they can forward them to them. A report is coming. And after discussing this with your input and the executive council's input, the report is better. If you have any suggestions or thoughts, you can email me and I'll be glad to talk with you. There's my email address and it's in the slides. Thank you. Thank you.
Thank you, Dr. Ralph. Great
Thank you, Dr.
information.
Ralph.
Certainly information for everybody to consider and to think about how they measure what matters to their organization. We are coming up to the end of our program, but now is the time to ask questions as well. So if you have additional questions, feel free to type them in the chat or the Q&A. We'll wait for those to come in. Very insightful comments coming in, Dr. Ralph. In the coming days, for those who attended, you'll receive an email with a link to the recording and the slides so that you can refer back to them going forward. And then, of course, watch for the survey report that Dr. Ralph mentioned. So that survey just closed. He started analyzing the data. We went directly for a webinar to share what we had, and he's going to then follow up with the report that will be released coming soon. So more comments on the presentation, very informative. Thoughts from the Executive Council?
Well, I think, these printing organizations throughout the, country are here for their participants. And in order to make us stronger as an industry, we need to, complete these surveys and share. I know that we have a lot of direct competitors. I get that. But if you do that through, Dr. Ralph or any other group that's putting together these benchmarks, it is super important for us to then get that data and share with our participants. That's why we're signed up as these groups. So the stronger we get better with the more participation we have. And we'll try to make it as a point to get this information out and make sure that that it's legitimate. Because a lot of the stuff looks like, oh, you need to complete this survey. Well, who's it from? So we as a group need to get out and advertise it first, say this is coming and here's who it's coming from. And then I think we can be better as a group.
Yeah, you make a great point, and I am working to find ideas to make it easier and better. I really want to improve the process, and I'll be bouncing it by Matt, Ryan, Carl, and Ken some ideas in the next few months, hopefully.
Excellent. I would share that confidentiality is extremely important to our group. There is never any individual information that is shared outside of the reports. It is all averaged and never specified. So feel confident that your information is always kept confidential.
It's kept in this room and it's not shared with the association leaders.
Right, right. The association leaders don't have access to it either.
Right.
There is a question from Paul. Dr. Ralph, have you done anything more on days sales outstanding and the impact on profitability?
The connection between accounts receivable, is that what he means?
Paul, if you'll clarify, days sales outstanding and the impact on profitability.
Is that accounts receivable?
Let's give him a second to respond.
That's a great question. Well, we have generally found lower days of accounts receivable and higher performers.
Mhm.
Yes. That's our general findings. Yes. Okay. Thank you, Paul. Yes, that's our general findings. They're managing that better. And I think the key to that is a system, not reacting, but proactively having a system to manage. We had printing companies, 2 of the 3 printing companies I had were growing at 25% a year. That soaks up a lot of cash. If we hadn't managed this, yes, Paul, I remember that. Yes. That soaks up a lot of cash, and you've got to monitor that.
Any additional comments or questions? Well, thank you, Dr. Ralph. Very insightful. We look forward to sharing the information and to your final report.
Yeah, it will come and the slides will come. I'll send those to you. Thank you to Chris and thank you to Teresa and the 2 associations, the Printing Association Midwest and Printing Association Mid-America. I love working with y'all. To the Executive Council, you have contributed so much to our discussion today and to my thinking. Thank you. And we'll keep at it.
Excellent. Thank you to the Executive Council as well. And we will send the slides and the recording as soon as they're available. Have a great afternoon.
Thank you.
Thanks. Bye-bye.